Welcome to the Trading Market Technicals morning call video for Friday, August 3rd. First Friday of the month is non-farm payrolls, and that's what we're going to be getting out today at 8:30. Very highly anticipated and closely watched number every month, and this is going to be a definite market mover, as it always is, especially today. And one of the reasons why we had ADP came out with their numbers. And it's a very volatile number. I really don't look too much into that, and but also their number was actually decent, as it was last month, and non-farm payroll numbers were actually worse than expected last month. But it really, as of right now, it really doesn't matter, right? We have a big bid in the market, and the market refuses to sell off. Hats off, and thanks to the Federal Reserve, and the ECB, and all the other central banks around the world, propping this market up without letting it naturally do what it has to do, and that just comes down to down the road another big sell-off, and that's what we have. That's what it looks like. What we might be anticipating. And this video is all about market divergence. And I want to recap quickly about yesterday. And Draghi came out. ECB didn't. They held on rates. They didn't do anything. Totally expected. Fed the day before didn't do anything. Didn't even offer another QE3, which I knew. I kind of felt like that was going to happen. Because basically, Draghi made a statement last Thursday stating that, we're going to do whatever it takes to protect the euro, and he did his job for him. And then on yesterday, when they had their meeting, he absolutely said nothing that was forthcoming to his statement last Thursday, and that's what we had. We had a decent sell-off in the pre-market, which is a little bit tough to kind of get short during the morning hours, and then we kind of chopped around and just grinded higher all the way into the close. So basically, we thought we had a good event risk day, and we had a non-event risk day because basically a lot of the sell-off happened early in the morning, and then we just kind of grinded higher. So, you know, when you can't shorten a hole, and insurers don't want to really look to be buying anything down here as well at this time. There are a few sectors that I do like, which I'll talk about at the end of the video, and I mentioned yesterday, and I've been mentioning the last couple of weeks. But this video is all about market divergence, and what I'm looking at in front, what I'm showing you guys, the industrials, the S&P cash, the Russell, and the composite. This is a 60-minute chart, and that doesn't really have to look, don't worry about the candles. I want to really look at the lines here. And the lines is really what's showing you what's going on, right? The industrials and the S&P are actually moving higher, while the Russell and the composite, and actually the transports, I just couldn't fit it all, are moving lower. And the three, Russell, the composite, and the transports, are market leaders, right? Where the S&P and the industrials are followers. And this is not what you want to have while the markets are moving higher. Now, yes, we did sell off yesterday a little bit, but they caught a big bid again, and they rallied, slowly grinding higher into the close. So it's all about risk right now, managing risk properly. When it's obvious, take the trade. Bottom line. When it's not, stay away. Cash is a position. And if you do 4 or 5 trades a week, if you do 2 or 3 trades a week and they're all winners, or you know, a ratio of 70-30, you're going to get paid. And that's really what it comes down to here. The markets are chopping around all over the place, trying to find some sort of direction. Every time the markets go lower, the Fed comes in, makes a statement to try to prop these markets up. It is an election year, and that's totally anticipated. However, we do have market weakness, seasonality trends, which I like to watch. I follow on a consistent basis. August is usually not a good month for the markets, at least the first 2 weeks. Now, if that happens and we have market divergence, I would anticipate some sort of a sell-off. And I keep saying, guys, anytime these markets are up, I would be looking to hedge any positions. If you're a swing trader or a long-term investor, hedge your portfolio with some puts, buy some protection, and that would be really the way to do it. If you're day trading, different story. We look for setups, look what they work. We protect our downside and or our upside if you're short, and then move on from there. But market divergence is upon us, and I wanted to make note of that. And even though the markets are up, the markets are not healthy. NYMO, our trusty McClellan oscillator, we are down at the 29 area, negative 29. Not that we're overbought or oversold, but there's plenty of room to the downside is what I'm pointing out if this market were to move lower. Now, again, this market is like a junkie. It's looking for news, looking for anything that to keep this market and move higher. Can it move higher? Absolutely. You can't rule that out. That's why just being blindly short the market is not good as well. And I know it's kind of tough. So, like, hey, this market's got market divergence. If it was like that 5 years ago, I would say perfect. Let's start looking to short on any bounces. We'll short the market. I want to see a lower high consistently, and I'll get into that. Shanghai. I keep pointing to Shanghai index. I know it's boring, guys, but I want to really point this out. This is not good. We rallied once, right? Oversold. Can't even get above this average here. Now, it is oversold. Yes. Can we get an oversold bounce? Sure. Maybe back up to here. If we see this market bear flag into this 20 and then roll again, that's going to be a clear sign that the Shanghai, China's in big trouble. I've been saying that for weeks now. All right. Let's take a look at our VIX. Now, VIX here came out of this wedge, bull flag, whatever you want to call it, either one, and then we got out of it, we back tested, and now we're kind of bouncing around. This usually, when you get out of this, this usually forms an inverted head and shoulders, right? So if you have a head here, your left shoulder here, your right shoulder here, which is symmetry is perfect, and then you'd have a slanted crossover here, a little bit of a neckline coming down here, right around a 21.5, really. So a break above this area here, 21.5. 21.75. That's going to put another buy signal into the VIX, a sell signal into the market. So I'm watching that closely. Another divergence, which I pointed out, is a ratio chart, right? We have consumer staples versus the consumer discretionary. Well, staples, if the market is healthy, consumer staples, this should be the opposite, all right? Consumer discretionary should be leading consumer staples, which is not. Okay, another market divergence here. What we have, the trusty dollar. We are at this area here, back up in this area. We actually sold off to the 20, broke the 20, held the 50, and now we're back up in this area. A break above this time, I think it holds. And the longer-term picture of the U.S. dollar, I showed you the weekly, and it was 88. If it does break this pivotal high here of 84, I think it's going to be a magnet to run that up. And when that does happen, that's going to be a sell-off in the market as well. So I want you guys to keep an eye on the dollar. Very important. I watch it closely every day. All right, so here's the week, right? The S&P 10-minute, nothing going on. Look at this. Just absolutely crazy. Unless you, like I said, you took a play for earnings after the fact. Obviously, we don't play earnings at all. Or a gap down in a stock, and then you traded it that way. This is absolutely ridiculous. Nothing going on this whole week. We're in a range. As well as commodities, currencies, all in range. We're all range bound here. Now, yeah, we did break down lower again. Pre-market, we were even lower. We bounced back, and then we just slowly grounded higher, lower, and then we grounded higher into the close. Now, it's going to be interesting really to see what happens today. Today is something that, guys, if you take a step back, if you have one or two trades, you're pretty much done for the day. It is a Friday, dead of the summer. I think whatever's going to happen is going to happen in the first hour and a half, and it's just going to grind all day long, either up or down, and I would really take note of that. I would be looking for your setups for next week. Look for trading next week, and really get your research done today, tomorrow. Did a weekend, and then get going for next week, because today's going to be pretty much of a dismal day, I would imagine. After 8:30, 9:30, 11 o'clock, the day's pretty much done. Trading. This is the S&P cash. Back up to the 61.8% retracement. As you can see how well this is holding up. We had two big down days, and now we're actually we sold off for the last 4 days, and we're basically above the 20, the 50, and the 200s, right? So it's really, if you're looking at just the S&P, it's not a bad looking chart, right? It's okay. 3 days down, two big up candles, engulfing candle, doesn't look bad. But when I show you this market divergence, really don't look too good. Okay, so we have this big wedge forming again, and as you can see here, back again to 20. This is the spider. I just want to show you the volume here. Then let's take a look at the other sectors. Now, this is the IWMs, right? Russell 2000. If the markets are healthy, I keep stating that, we want to see the Russell participate. Clearly not participating. Broke this longer-term downtrend line, right, back from June. So this is valid, right? 1, 2, 3 touches, breaks lower, can't even get back inside of this area, okay? Now, yeah, it did actually close with a green candle, but it's again not what you want to see. This is clearly market divergence here, and this is something that really scares me. This here in particular, transports, right? The IYT. We have a head and shoulders pattern, which is a bearish pattern, obviously, and we have this longer term trend line, and of course I drew this symmetrical triangle in here. So we have a couple of patterns. which ways are going to break. If this pattern is valid, it should break lower. I think, again, when you get this Dow theory sell signal, okay, because the transports are diverging from the industrials, and when a Dow theorist, when there's a Dow theory sell signal, what they do is they sell the market, and I think that's going to force this market lower as well, because there's a big follow on the Dow theorist, so they're going to look to sell this market if this does confirm here. A couple more charts, guys. Actually, one more. Last one. Big cap tech held up well, right? It's above the 20-day, and we had some big volume come in, and we closed green. So it held up well. So there's some sectors that are holding up well. A lot of sectors that are not. As you know, the Russell, the transports, the banks. Banks are really holding up ugly. They really look ugly. The consumer discretionary. Okay, and you have some of the semiconductors that got decimated. Okay, so just keep an eye on these sectors and do some homework over the weekend. I'll have a full analysis on Monday. Some of the sectors I do like on pullbacks. I still love the coal sector. And even though the coal sector obviously sold off yesterday for profit taking, I will be looking to buy coal on any pullback, whether it be a call or buy the stock itself. And I do like the two I like is the ACI and ANR. They're one of my favorites. All right, guys, have a great day. Watch closely what's going to happen with the non-farm payrolls, and we will talk to you on Monday. Take care. Have a great day, everybody, and enjoy the weekend.